Are negative interest rates the answer? The European Central Bank took an unprecedented step on Thursday of cutting the deposit rate it offers to banks down into negative territory. Now, we've seen a long history of 0% interest rates, both from the Federal Reserve since 2008 and also from the Bank of Japan, but this is the first time a major central bank has actually gone through the zero bound into negative territory, which really kind of flips the way people think about the bank-deposit relationship. So this means that essentially banks, commercial banks, are going to be paying the European Central Bank for the right to hold their money, which is somewhat of a foreign concept for most people. Now, why did they do this? Europe has seen a real slowdown in its economic growth. It's also seen a real slowdown in inflation levels, and this is really causing concern about the risk of deflation or falling prices, which is very dangerous in a situation of high indebtedness and really brings up memories of Japan's long malaise with both debt deflation. So Europe is trying to avoid this by cutting interest rates into negative territory in the hopes of escaping it. Now, what's the outlook going forward? Well, U.S. financial markets are responding very favorably, with both the Dow and the S&P 500 pushing up into new record territory, but the European Central Bank really needs to see the euro move lower to restore export competitiveness, and the reaction from the financial markets on Thursday is not what they want to see. The euro is actually strengthening. Perhaps there's some disappointment that the European Central Bank wasn't even more aggressive by unveiling also a bond buying program of the type we've seen from the Federal Reserve. So going forward, it's going to be an open question about whether this is enough to kickstart growth for Europe and whether or not the ECB is going to have to take additional action going forward.